Most DeFi participants are playing a guessing game with yield. They deposit into a liquidity pool, watch the APY fluctuate hourly, and hope the number stays attractive long enough to matter. That is not a strategy. That is speculation dressed up as income. Pendle Finance offers something structurally different, and right now the setup is unusually compelling. Here is the core mechanic. Pendle takes yield-bearing assets, things like staked ETH, USDC deposited in Aave, or liquid restaking tokens, and splits them into two separate tradable components: the principal token, which represents the underlying asset redeemable at maturity, and the yield token, which captures the variable yield generated between now and that maturity date. This separation creates a fixed-rate market inside a system that was never designed to have one. When you buy the principal token at a discount, you are locking in a known return at a known date. No variable rate exposure, no governance token emissions inflating a number that evaporates next week. Just a spread between what you pay today and what you redeem at maturity. That is fixed yield. In DeFi, verifiably on-chain. So why is this the smart trade right now specifically? 3 reasons. First, the macro context. Interest rate expectations across traditional finance are shifting. As central bank rates begin to move, capital sitting in on-chain variable rate protocols becomes increasingly unstable. When rates drop in TradFi, yield chasers flood into DeFi, compressing variable APYs rapidly and unpredictably. Locking in current yields before that compression happens is not conservative, it is tactical. Second, the current yield environment on Pendle is pricing in uncertainty that may not materialize. Look at the implied yields on PT-WETH or PTSUSDE across active pools. Several are trading at annualized fixed rates between 8 and 14%, depending on the pool and maturity. These rates exist because the market is discounting the possibility that underlying variable yields will fall. If those yields hold or rise instead, you have captured a spread the market was pricing as a risk premium. You get paid for absorbing uncertainty that did not show up. Third, the structural advantage of known exit conditions. Every Pendle pool has a fixed maturity. You know exactly when you get your principal back. That predictability has real portfolio value, particularly for anyone managing liquidity across multiple positions. It removes one entire variable from the equation. Now, the risks deserve equal weight. Smart contract risk is non-trivial. Pendle has undergone audits and has operated without major exploits, but complexity in yield-splitting mechanics means the attack surface is wider than a simple lending protocol. Sizing accordingly is not optional. It is required. The underlying asset itself carries its own risk layer. If the yield-bearing token depegs, for example, if a liquid staking token loses its backing, the principal token's redemption value is affected regardless of Pendle's own mechanics. You are not just buying a fixed rate. You are buying a fixed rate on a specific underlying, and that underlying must be evaluated independently. Liquidity risk also matters near maturity for larger positions. Thinner pools can create slippage if you need to exit before the maturity date rather than redeem directly. None of these risks make the trade wrong. They make sizing and pool selection the actual work. The deeper point here is what Pendle represents structurally in the DeFi stack. Fixed income is the largest asset class in traditional finance by volume. DeFi has spent years trying to replicate equity-like speculation with leverage and liquidity mining. Pendle is building the other side, the part where capital earns a predictable return within a defined time horizon. That is not a niche product. That is infrastructure. The current moment combines elevated base yields, a market pricing in downside on those yields, and a maturing protocol with real liquidity across major pools. Those 3 conditions together are not permanent. They are a window. The takeaway is this. Fixed yield in DeFi is not a compromise. It is a different instrument serving a different function, one that most on-chain participants are underutilizing because variable APY dashboards are louder and more visible. Pendle makes the fixed rate legible, tradable, and composable. In a market environment where yield compression is a credible near-term risk, locking in known returns before that compression arrives is not the cautious move. It is the calculated one.